Bismillahirrahmanirrahim. Now I'm going to continue with the next requirement. Requirement number 3. Question 1 is prepare the journal entry to record all transactions related to factory building B for the year ended 30th September 2019. So now we are looking at only for factory building B. So factory building B, okay, the initial cost is 18 million, the useful life is 50 years, and using the monthly basis, and then we take up the additional information number 3, and then we have to prepare the journal entry. Now we also look at here information number 6, whereby it says here the company choose to transfer some of the surplus to retain profit, okay, and when the PPE is used by the company. Alright, so now we draw the timeline again. Timeline is very important so that you can understand the full picture. Now this factory building was acquired on 1st October 09. Okay, so we will draw this one for factory B on 1st October 19. The initial cost was 18 million. Okay, this one. Alright, and then the useful life 50 years, and again the straight line the method is a monthly basis lah. Okay, and then based on the information number 3, on 1st October 18, the fair value of B factory building B is 20.5 million. So 1st October, okay, this one 09. So on 1st October 18, given the fair value is 20.5 million. Okay, so meaning that that is all information about factory B. So it means that you revalue your factory B on this date. And you know that our current year ended on 30th September 19. So this is current year. The question asks you to prepare journal entry for the year ended 30th September 19. Okay, so the wording of the question here, for the year ended, that means you have to show all entries from the beginning of the year, which is 1st October 18 until 30th September 19. This is 1 year period. Okay, so it just happened that at the beginning you revalue your factory building. So you have to show all the journal entry throughout this period. So when you revalue, you compare the fair value with the carrying value. So carrying value is cost minus accumulated depreciation. So we have cost here is 18 million minus accumulated depreciation, that means from the date you purchase up to you revalue. So what is the period? Okay, from October, so you start to count 30th September 10 lah. So 10, 11, 12, 13, 14, 16, 17, 18. Okay, you stop at 18 because 30th September 18, the day before. Okay, so that will be 9 years. Alright, so you calculate the accumulated depreciation. So that will be cost 18 million divided by the useful life 50 years and times with 9 years. So you get 3240. Okay, so you minus dekat sini lah. So then you will get a carrying value of 14760. This is the carrying value. So the fair, now you compare the fair value and the carrying value. So you see that fair value is more than the carrying value. Fair value is more than the carrying value. Therefore, you get a surplus. So you minus the figure. So you will get surplus of 5740. Okay. So now, remember. Okay. Whenever you revalue your asset, first treatment will be either surplus or deficit. So for this question, you got deficit. And you must always have the second treatment, that is to eliminate accumulated depreciation. Okay, these are the two things that you have to remember. Whenever there is a revaluation, okay, when there is a revaluation, these are the two things that you have to do. You recognize the surplus or deficit and you will eliminate accumulated depreciation. Now, if you look at back the previous one when we did on land, okay, we did revalue the oh tak ada, this one, oh not this one, okay, this one, you revalue your land here, right? But you see here, you only recognize the surplus, okay, the surplus ni. But there was no elimination of accumulated depreciation. Why? Because land is not depreciated. That's why we don't have that second treatment. But for this one, this is a depreciable asset. The factory is depreciated. Therefore, whenever you revalue, these are the two things compulsory that you have to do. You have to recognize the surplus or deficit. And second one is to eliminate the accumulated depreciation. Which one? Accumulated depreciation? Of course, this one that you have calculated before. Alright. So, why the standard require us to eliminate the accumulated depreciation? Because whenever you revalue your asset, the next time when you calculate the depreciation, okay, so the depreciation for this period, okay, I put it as a current year depreciation. So, this new depreciation will be based on the new value, based on the revalued amount. Therefore, we are no longer required to carry this accumulated depreciation. That's why we have to eliminate. Okay, so when we now we have done this. Now in this year, you have to calculate the new depreciation based on the new value. So depreciation, of course, you take 20.5 million. Okay, 20.5 million and divided by the remaining useful life. Okay, remaining useful life. You don't divide with 50 years. Okay, no. Because this is a new value. At the middle of years, you revalue your asset. So this is a new value. So the useful life should be the remaining. So what is the remaining useful life? The estimated useful life is 15 years, you deduct with 9 years. So therefore the remaining useful life will be 50 minus 9. That will be 41 years. So you bahagi dengan 41 years lah. So you will get 140,000 current year depreciation. Okay. And then if you look at the question, it says here, the company choose to transfer some of the surplus to retain profit. Now you get surplus for this question. So you have to transfer that surplus to retain earning ataupun retain profit. How do you transfer? What is the amount of the amount of surplus that you need to transfer to retained earning. Now, the calculation is similar to depreciation. Okay, because you transfer the surplus annually, just like depreciation you charge annually. So the amount of the surplus is 575040. Then you divide with the remaining useful life of the asset, 41 years. So you get 140,000. So this is the amount that you will transfer from ARR to retained earning every year. Okay, this is per year. Similar to depreciation. Unless depreciation nanti somewhere here maybe you revalue, then the depreciation will change. Okay, so now let's answer the question. The question asks for journal entry for the year ended 30th September 19. So whatever transaction that happened during this period, we need to prepare the journal entry. So the first one will be on the surplus. So surplus, the journal entry will be, you increase your PPE, that will be factory, what is this? This is factory B, right? So factory B, 5740, and you will credit your ARR 5740. And then the next entry is to eliminate accumulated depreciation. So eliminate accumulated depreciation. Okay, now when you eliminate accumulated depreciation, when you create accumulated depreciation, you will credit accumulated depreciation. When you credit accumulated depreciation, it increase. But now you want to eliminate, you have to decrease. Therefore, you will debit accumulated depreciation. Alright? And credit upper, of course, you will credit the asset, which is you credit the PPE. Factory B. So the amount that you eliminate is the one that you calculate here, 3240. Alright? Okay. Next entry is on the depreciation here, 140, the current year depreciation. Depreciation. So you debit your SOPL and you credit the accumulated depreciation on the factory B. The amount is 100. Sekejap Kok salah. 20. Saya salah kira ke ni? Salah ni. 20.5 divided by 41. Berapa? 20.5? Oh, 500,000. This is not 140. This is 500,000. Sorry. Okay, so this is should be purple. Okay, 500,000. Okay, is that correct? Okay, and the last one is transfer ARR to retained earning. So the journal entry, when you transfer ARR to retained earning, it means that transfer out from ARR. So when you increase ARR, you credit ARR. So when you transfer out, you will reduce. So you will debit ARR and credit the retained earning. You take out from ARR and you put into the retained earning. That's why you will credit your retained earning. It means that your retained earning will increase. So the amount is 140,000. Okay, now that's it for that question. It's just that I want to explain to you why the standard allow company to transfer its surplus into retained earning. Okay, now you see here when you transfer from ARR to retained earning, you actually increase the profit. Okay, the profit of the company because you credit retained earning. If you have learned publish account before, when you increase your retained earning, which means that your reserve will increase in the SOFP. Okay, why do the standard allows that? The company can choose not to transfer now. The company can choose to transfer the AR to retained earning when they dispose the asset. Masa tu boleh transfer, but now company can choose to transfer annually. Why? Because the reason is that is to compensate when you get a surplus for your asset. Okay, when you get a surplus, it means that your PPE will increase. Okay, that's why you debit PPE. And what happen when your asset increase? Your depreciation will also increase. That's the effect. So depreciation is expenses. So when depreciation increase, your expenses increase, which means that your profit will reduce. So it seems that, oh, it's not good when we revalue our asset, and if we get surplus, the profit for that year will decrease. Nampak macam tak bagus kan? So now the standard allows that if the company doesn't want this to take effect, so what the company can do, they can compensate, transfer, okay, macam gantikan semula, you transfer the ARR to retained earning annually. So this one, you can transfer to your retained earning so that your profit akan bertambah semula lah. Okay, so that is basically allowed sebab kita nak encourage. Okay, we want the standard want to encourage company to use that revaluation model and surplus. If you get a surplus, it is not disadvantage to you. Okay, that's why standard allows that because of this effect, alright, you can transfer your ARR annually to retained earning. So this 140, when you transfer back to retained earning, it will increase back the profit. But anyhow, when can company transfer ARR to retained earning? Okay, sama ada when the company continue use the asset, so that means you will calculate similar like depreciation, you will transfer annually. Okay, you will transfer annually. Or if you do not want to transfer annually, the company does not choose this option, what the company can do, you need to transfer ARR to retained earning when the asset is disposed. When you sell the asset, then you of course you have to close everything, right? You have to close the asset account. You have to close the accumulated depreciation account, and then therefore if you have ARR also you have to close the ARR. So if company choose the second method, that means if you have a total ARR of 50,000, that means everything, the total will be transferred into retained earning. Okay, so this is up to the choice of the company. Now, when do you need to transfer ARR to retained earning? Only if the question mentioned about it. Okay, in this case, the question did tell you about transfer. If it's just silent, then you don't have to do this transfer transaction. Okay, so for this question, it is enough that you answer number 1, 2, 3, and 4 so that you get full mark. Thank you.